Hello and welcome everyone. Today we're going to be talking about the battery thematic. It's much talked about and much understood, I hope. Autonomous battery powered cars are the future. But I want to talk about today and the reality for junior mining companies and investors in the within that battery thematic. So today I'm joined by Brendan Urich, CEO of Regular Royalties. We've got David Kelly, CEO of Chakana Copper, and Terry Lynch, CEO of Power Nickel. Hello, gentlemen. How are you? I'm going to start by asking you to just give us a little summary on each of your companies. Brendan, can I start with you?
Yeah, sure. I'm the CEO of Regular Royalties. We are a royalty company focused exclusively on those metals really required for the transition to clean energy. Metals like lithium, cobalt, nickel, copper, etc. We've got a portfolio of 19 royalties, primarily targeting those deposits in North America, Europe, and Australia that could serve as a future source of supply of these metals for the gigafactories coming up under construction in those jurisdictions. So we're just getting started. We got cash flow and definitely a little bit heavy lithium right now, but looking forward to the future.
David?
Yeah, thank you, Matt. It's a pleasure to be here again. Dave Kelly with Chakana Copper, and Chakana Copper's made a very exciting discovery. It's a high-grade copper, gold, silver discovery in Peru. We just put out our first resource in January of this year that contained 191,000 ounces of gold, 11.7 million ounces of silver, and 130 million pounds of copper. And that's just on a very small part of the deposit. We've only tested 15% of our targets to date. And we know that that's going to dramatically expand the footprint of the resource. We have a strategic investor in Gold Fields that's invested every time at their investment rights since 2019. So it's great validation to have a quality company like that investing in Chakana Copper.
Thank you. And Terry?
Great. My name is Terry Lynch. I'm CEO of Power Nickel. Power Nickel is developing the NISC project in just south of James Bay, Quebec. It's a high-grade nickel sulfate project. Had a historical resource of 3.1 million tons of about 1.7% nickel EQ. We'll be updating that, hope to get that out in May, a new update of 43101. Just had a successful drill program, and we're doing another one starting in June 1. So pretty exciting nickel project. We're happy to sort of be bringing that to the world.
Thanks, guys. I appreciate that, the summaries. Right, you guys are all three of you, sub 30 million market cap companies, but you're absolutely right in the center of the battery thematic. The way people are talking about it, the way governments are talking about infrastructure bills, the way OEMs, automotive manufacturers are talking about it, any commodity related to batteries should be flying off the shelves. But right now, the market doesn't seem to understand that. What's going on, Brendan?
Well, it's absolutely crazy. I think I was just talking to you guys earlier. Our portfolio is heavy lithium, about half our portfolio. Lithium prices are up 400% over the last year. Our share price is down, about 40%, it seems like. So it's weird. There's a disconnect between metal prices and the companies that are actually involved with the extraction, have participation in these metals. So it's weird. I think the thematic's not going anywhere. You just look at the new Green Deal that the EU put out. They're going to require, 20 times more of everything. It's weird. It's kind of crazy how a lot of these governments have not really been forward thinking. China's been ahead of them for 10, 20 years now, going out, basically securing all of these assets across the world. So yeah, it's weird that, these countries are Europe and the US are really kind of coming late to the party, but you definitely see them shifting that and kind of learning like, okay, maybe we need to have some domestic sources of these metals so that we can, build out all of the things that we have in our current day lives.
So, David, talk to me, because you're in the US. The US is talking a big game about what it needs to do, this conversion over to battery into renewable energy. What are they doing to support juniors?
There's a huge disconnect between what society wants and how they can get the metals that they need to have that. And that, there's a lot of, you see the narrative is changing. Now people are talking about, where is the supply going to come from? What does that supply look like? What's it going to do to the environment? And there needs to be a lot more support for the junior segment. The junior segment's always been a critical part of of the mining industry. The junior companies are the ones that generally take the higher risks. They'll go into jurisdictions that other companies won't go into. They'll take on projects that are maybe not mainstream in terms of the type of the deposit or the technology used to recover the metal. And it's oftentimes those companies, those juniors that are taking that risk that make those breakthroughs. So you not only need the support of governments, but you need the support of capital markets, investors. It goes full circle. And I think what we're seeing right now with the depressed junior market share prices is that support is not there. It creates an unprecedented buying opportunity, I think, for investors. But this is the time when people really need to step back and look at the value that these junior companies right here on this panel bring to the table and what they can do for your investment portfolio.
So Terry, you're up in Canada. David says, it's not just the governments, it's also the markets, it's also the financial institutions. You've got a little bit of experience on some of the behavior with some shorting. What's your take on how the Canadian governments, provincial or federal, are approaching mining?
Well, it's funny. I mean, the last federal budget, which just came out, less than a month ago, basically every, electric metal stock in Canada should have jumped 15% because they basically said, hey guys, you're going to get a 15% tax credit to develop, your project. I mean, it's unbelievable. So it's like, yeah, there's nothing. Stocks went down. And, Matt, I've been on the show before talking about short sellers, as being a structural issue in our marketplace. And I really truly believe that's a problem across the board. And it affects the individual investor more than most because, the Eric Sprotts of the world, the sophisticated investors, many that we have in our companies, they look through the deposits and turn them over and find the good ones and understand what that math will be like at the end of the day and bankroll it. But the retail guys, they can get spooked out very easily, so if you get it in, right now you've got a bit of a shaky market globally because of obviously the global events, and it's been a long running bull market. People are moving away from tech into what, hope, the obvious answer is to move into the, in my view, resources. We're ready for a massive boom, and this will be a boom like no other. Now, when it will start, if I could tell you that, I'd be a lot richer than I am today. But it's coming for sure. That's my view.
Well, no, I think you're right. People are moving out of tech. If our subscriber base is anything to go by, that's what people are piling out of that and into natural resources for sure. Brendan, you are kind of cross jurisdictions in many ways because you're after the commodity, it's that underlying commodity. But what are you seeing jurisdictionally in terms of the way that governments are supporting junior miners? Are they all doing it the same way? Are they being as supportive as they can be? Does it affect your decision making when you're thinking of royalties in different jurisdictions?
Yeah, I definitely don't think I've ever thought of governments as a plus really for any development project. I mean, you look at what happened in Serbia, Rio Tinto, they've spent a lot of money on that project. It was supposed to be a very key lithium mine, for the future. And then the government basically says, no, we're no permits for you. So, you look at that, you look at Chile. I saw Anglo today just had some of their expansions shut down by the Chilean government, planning to extend a very big copper mine out to 2036. So, and that's a big risk, right? And that's kind of comes out of nowhere. Governments do change every 4 or 8 years, and so it's tough. There was funny, the US did start to get into it. You had Department of Defense, Department of Energy running around and, offering up big debt financings to groups. But I mean, even those guys were going to the wrong place. So there's a definitely capital allocation issue where even the money that is kind of being allocated to this space isn't really making it to where it should be.
But will it come? Brendan, I'm going to stick with you for a second. But will that come? Because, OEMs, right? They're saying we need more of everything than exists. We need more lithium than exists today. We need more copper than exists today. We need more nickel than exists today, right? There's going to be a massive deficit. Well, it depends on which numbers you want to believe, between 2025 and 2030, right?
Yeah.
Something's got to give. The market's got to just... Well, do you think this game's being played? Is I guess where I want to go, right? Do you think institutions are playing a game? Do you think shorters are playing a game? And this is a temporary thing. And if you're strong on the thesis, should you be more contrarian in your approach? Are there deals to be done now, Brendan?
Yeah, I think there are, and it's funny, as a public company, you're always hit with that, markets are efficient and, you are valued at where you're valued because you're a public company. I think the big private equity groups, especially look at our portfolio and they know what we have. And so that's kind of always our comfort is, the smart money, we know what they would pay and we're not planning on selling anytime soon. I think it's very defensive, right? It's tough. There's a 15-year average development timeline in mining. So yes, the money better come soon or we're going to be really in trouble because you can't overcome that big period of underinvestment. I always joke like you need more tin today. Great. I'll go poke a drill hole down. Oh my God, we're so lucky we found tin. I can actually maybe get you some tin now 15 years from now, right? So, if the money doesn't come soon, it's only going to lead to more price spikes. We're probably already 5 years late, right? The whole revolution's just got going. We're experiencing exponential growth forecasts going out basically 2 decades, and prices have already gone crazy. So, the money better come soon, and I think it will because you do have these higher prices that incentivizes more money to the space. So this should be an exciting couple of years ahead. I think people are starting to turn that page and turn that corner.
Okay, David, you said to me earlier, you said that people need to be brave. There's some bargains, there's some deals to be had here in this market. Now, if I look as a typical retailer, the blend of my portfolio, I'm going to have some production, I'm going to have some development and some exploration. And the exploration is where I get the super high leverage. It's the highest risk, but it's super high leverage. So if I am to be contrarian in my attitude, if I am to be brave in my attitude towards exploration companies with battery thematic attached to them, what am I looking for? What do those companies need to look like?
Yeah, so even within the exploration space, you can separate the junior companies that have resources, the ones that are sitting on a new discovery. Those intrinsically should have much higher valuations than the explorers, the project generators, the people that are out trying to make the initial discovery. So, what I've seen is, it's kind of a trickle down effect, right? You can invest in producers, that they are generating revenue, good profits, metal prices are high, that's great. But as soon as the commodity prices start to rise, right on the heels of that is an increase in the cost structure to get the metal out of the ground, right? So now we're starting to see the earnings reports from the big producers showing less margin because their cost structure is increasing. And so, there's a move to downstream, higher leverage developers, people that are bringing on new production. And then, the juniors that have resources sitting there, these are really, really attractive resources. And just like Terry was mentioning, higher grade, they've got a higher grade deposit, we've got a higher grade deposit. That's even better for the environment when you think about production. So there's a real opportunity right now for investors to go out and cherry pick primo assets with huge upside potential in mining jurisdictions. You can, the world's your oyster, right? You can choose to invest in risky jurisdictions or more secure. It's completely in your control to go out and cherry pick these opportunities. But there's, like I said, there's an unprecedented opportunity right now to fill up your portfolio at a certain percentage level with some really quality junior companies.
To David's point, I think it's really key to have that difference. They already have a resource. We're not making many new discoveries these days. You look at the copper space. I think we're going to need the equivalent of basically the biggest mine we have on the planet, and we're going to need to find that every year or so to keep up with where we expect demand to be. So having a resource is key. That eliminates a lot of the risk. I think if you look at really what an expert, somebody who's had 10, 12 years in the field versus a retail investor, the real edge would be being able to look at a resource and kind of tell, from there where it's going to go. But I think that's really key. You want to have a resource, at least. That's a big step. And that's metal in the ground. That's you can't print more of this metal. It only occurs in a few places, and so it's precious. And that's really a lot of the value proposition, I think, of investing in a mining company. They have that metal in the ground and they own it.
I've worked a bit with Eric Sprott on the Save Canadian Mining front in terms of the combating the predatory shorts. And I, just as a, chatting with Eric and, learning from him, I said, so Eric, how did, what was your big success? Are you, and because obviously he gets to see pretty much every deal. He's looked back at it because he's actually an actuary, an accountant in approach. He said, I back tested it. He said, I can't really, you never really know when you're buying in the resource initially if it's, he says, it's a crapshoot. You can buy it from a guy you think is not very trustworthy, but you like the rocks. And you can buy it from the guy who's had the 3 last successes. He says, it's still a crapshoot. So he said, the first round, you never know. So in exploration, it's really a roll of the dice, even with the best of them. But he said, where I'm really good is if I see that resource, I see those drill results, then I know that's got the hops to become a mine. And he says, I'm 20% the rest of the way. And he said, that's how I got rich. And I think it's an educational element for all of us, is that, there's obviously got to be risk money for these prospect generators and pure exploration guys. Otherwise, we'd never get to having a resource. But right now, where it seems to have broken down is there's very little difference from raw exploration to somebody who's got a resource. I mean, they're so compressed. There's no delta there. They used to always be. And you have to, and that's, that delta has to be put back in the system in some way for it to function properly. So I'm looking forward to when that's happening. I think that's going to happen soon. I think you're now like, I'm in London to go to the Mines and Money show tomorrow, and the first mining conference in a couple of years, I think, a physical one. And, from what I understand, it's going to be packed. And I think you're going to start to see a lot more general investment interest in mining. I know we're getting a lot of calls and stuff. So I suspect it's coming, but it's been slow, probably slowed a bit by COVID, slowed a bit by this horrific war that's going on right now and the geopolitical events. But at the end of the day, I think what everyone's saying is that if it doesn't happen soon, there's going to be some seriously bad downstream effects. So I expect it's imminent, but it can't happen soon enough for us.
Well, I think the one thing everybody, the retail investors and the general public really misses out on is what the supply side situation looks like. You take zinc, for example. It's a big market. I think it's about 12 million tons a year in annual demand. I've met 1,000 people, probably call it over the last year. Most of these are mining experts, the people that we'd have the most experience in this space. And I could have a intelligent discussion about zinc supply with maybe a dozen of them, so that's amongst like a crowd of people that really should know. And so that's the crazy thing. You talk about we're after 9 different clean energy metals. These were all pretty small markets. There's very few investors out there that really understand that supply side, because there's very few people in the industry that really have a sense and grasp of, the different supply chains for these commodities. So it's an interesting time. It's definitely a good time to be in this space, where we are, I think.
Brandon, when I started my career just on the supply side, I was told that 1 in 50 geologists in their career will make a discovery that turns into a mine. And, at the time I thought, it doesn't sound very good to me. Maybe I should be an accountant or a lawyer or something. But you know what? Today, I would take those odds in a heartbeat. It's gotten a lot worse. It's a lot harder to make discoveries these days. And it's, the world's been hit pretty hard by some very, very, very good exploration companies, big giant majors. The junior explorers have been tenacious in getting in where they can. There's still plenty of discoveries to be made, but they're a lot harder. Head grades are dropping into producing mines. The discoveries are getting deeper. The resources are deeper. So it's only going to get harder as we go forward, not easier. A lot of people think that technology and artificial intelligence and these types of things can dramatically improve our discovery rates. It's not going to happen. So I agree with you on the supply side. It's going to get a lot more difficult, and discoveries, when you make them, they should be even that much more valuable.
Yeah, that's a really good point you make there, David. Here's a bit that gets me. If I'm sitting with my retail investor cap on here, I'm listening to what you guys are saying, and I'm still trying to work at. Coming back to where at the beginning of this conversation is, there's a retrenchment in the marketplace. There's a nervousness around some of the things that you guys talked about, Russia, Ukraine, the economy, printing of money, taxes, less disposable income, less less discretionary spend, I should say. I'm now worried about paying electricity bills or fuel bills or car payments and things like that than perhaps investing. But for people who are on the margins there, that's a fair enough concern, right? But for investors who do have disposable income, they too have kind of stepped back and said, I'm going to sit in cash for a bit here. What's the thing that's going to get them over the line? I mean, is it you've got to be brave and go after, have the courage of your conviction, or again, is it fair enough that they sit and sit on their cash? What are you doing as businesses? I mean, Brendan, what are you doing as a business? How are you looking at the market?
Yeah, well, I think we're a little bit unique as a royalty company. Ultimately, I think we have a very defensive nature. We're insulated from inflation in terms of the operating costs because we don't have operating costs. We're insulated from capital cost inflation because we don't have to contribute for development costs, capital costs, cost overruns, et cetera. And ultimately, we're targeting metals that are very rare. We have the only manganese district in North America being developed for the EV space. Our producing zinc royalty is vertically integrated, the only primary zinc producer in the US. So we have very rare assets, and you can't print them. Like I said, you can't make more of these. It's average development timeline 15 years, so you can't even go out there and explore and remove that. So we're very defensive. I think for an inflationary environment, you're much better off investing in a company like ours where prices are going up 400%. That's a 400% increase on our expected revenues. Versus your, cash is definitely gonna, they'll say lose 7 or 8% purchasing power this year if you're just gonna lock it away. So I don't think you can ever be timid, in terms of investment. But I think we're very well placed for this type of environment specifically.
I think the institutional and high net worth family office type of investors are starting to come back now. That's going to be the ones that turn the tide, I believe, because the retail guy is generally a chartist right now. They've been trained by Robin Hood and by everyone else that you got to follow momentum. So momentum obviously isn't there now. So I don't see them coming in. You might get the odd one that's actually forward thinking, that's bought some good newsletters like Crux and whatever, and has learned that, hey, you got to, now's the time to get the bargains. This is where you multiply your returns. Hopefully there's more of them will come. But I think generally speaking, the not the giant institutions, but I think the midterm institutions and the high net worth family offices are going to lead the changing tide here, because they're moving, they're liquidating their tech portfolio or lightening up. They're never going to go to zero, but they're shifting, balancing. They're balancing their portfolios, and I think those guys will ultimately, for a core group of mining stocks, they'll turn the charts. And once the charts start to turn, look out, because that's when momentum guys start to come in, and they could keep on coming, because these things be nothing for all these stocks that are on the screen to be 10x 12, 18 months from now, which sounds crazy. Sounds like something in a crypto world, but honestly, that's where it should be, and I fully expect that's going to happen. There's going to be 10 baggers and 100 baggers in this space, and we're going to get in on some of them.
I was expecting more of a fight after what Brendan said. Apparently, his product's better than yours.
We're not competitors. There's lots of money for Brendan's deal and for my deal.
Yeah. Right. Well, actually, go on, David. What do you think? Are royalties a better bet than regular mining equities?
Well, I certainly invest in royalties. I think it's a great business model. It's a company, these companies have, 20 people on their payroll, and their revenues are just enormous. So it's a great business model. I think they provide a real, they fill a gap in the capital markets that serves a real purpose. It's obviously, better to manage that through the life cycle of an asset as it's going towards development. But I'm a big fan of the royalty companies, and I think Brendan's group is really smart. They're latching on to the battery metal and the clean energy supply, approach, and I think that's really key. But no, I'm a big supporter of these royalty companies for sure.
But your company's a better investment, surely.
But you definitely want to go higher leverage with Chicana Copper for sure.
Okay, right. Okay, it seems like I'm not going to be able to start a fight between you, so I'll give up now. But let me think about some of the other things which would stop me from moving forward as an investor into mining companies at the moment, or royalty companies, which is inflation. I think Brendan's going to tell me he's anti-inflationary in a second, but I'll let him talk last. Can things like inflation destroy some of these marginal projects, or will the increase in commodity prices kind of save the day? What's it look like going forward, Terry?
I think somebody commented earlier in the piece here about grade. I think it was maybe David. Grade is your friend, man. It doesn't matter if it's in the boom cycle or in the bust cycle. At the end of the day, it's always better to have grade, because it just makes so many things easier. And I think, the challenge we have right now, it happens every time in a cycle. You'll see these projects that have been around for 20 years. Yeah. They were around, and they keep, and then it's a hot market. And man, is it going to get financed this cycle? There's some, like in the nickel market, particularly, there's just a boatload of these billion-ton, 0.2% nickel, cost $1.5 billion, maybe, and it's like, wow, God bless. I think some of them will have to come off to actually feed the actual shortages that we're going to have, because these things are massive and reliable. But I think that at the end of the day, it's really, if you think it's hard to raise, $200 million to put a power nickel in play, God bless, raising $1.5 billion to put some of these others in. I mean, it's just so tough. So I think, grade is one thing for investors to pay attention to, because that's very likely to carry lower risk.
Right.
We had a saying when I worked at Western Mining, we had a saying, once a dog, always a dog, and it's referring exactly to what you just said, Terry. If you need high commodity prices to make your project look good, then there are some real problems there, because grade helps you make good money during a down cycle, and then absolutely kill it during the top of a cycle. And higher grade usually means lower capex, faster return on your initial investment, higher margins. It overcomes a lot of issues, even engineering problems. So yeah, I agree with you. Once a dog, always a dog.
How do the royalty companies feel about it? Inflation?
Yeah, well, look, maybe I won't defend us. I think I got our key points there so much. I think I could actually just say, where we're looking, where we'd be investing, would be actually projects much like Terry and David have. They're a little bit smaller, right? You look at these mega projects, always run into big hurdles. You look at the capital costs on these things, they always get blown out, and $1.5 billion becomes $2.5 billion pretty easily. And so I like these higher grade projects. I do think, if you were to invest in mining companies, definitely higher grade, smaller footprint. Both these projects have, I believe, the capability to do underground. That's very good from an ESG perspective. But yeah, I do think these guys are the guys that are going to be making it into production a lot quicker than these, so-called mega projects that are attract the attention of presidents and presidents' sons to shut them down. I think that these guys have the right idea. Grade is king.
Yeah, for sure. President's sons. Let's not get political.
I'm just thinking about that one up north, Pebble, I believe.
Yeah, I think we know what you're talking about. Okay, so if I'm again coming as a retail investor hat on here, and I'm looking at this metals, we're looking at the battery thematic, but more broadly, sort of junior mining. You think it's okay? We're in it's a temporary, transitory moment of reflection for the marketplace. Maybe some of the institutional guys, maybe some of the PE guys are playing a few games, but this is a kind of reset, recalibration moment rather than a kind of really negative outlook for the market as a whole. Is that what you say?
I think it's an educational thing, really. Just educating the market. The mining market's been traditionally a very small market dominated by a few key investors. Terry mentioned Eric Sprott. A couple of years ago, he was responsible for, I think it was over half of the junior mining financings that happened, over a 6-month period. One guy, he's fairly wealthy, but he wouldn't match up.
That's not a good thing, right? That's not a good thing.
It's not a good thing. No. So the last 10 years have been very tough for mining. We've had a big exodus of people really across the sector. I was one of the very few people that got hired 10 years ago in the market, and I didn't see anybody really getting hired for about 5-6 years after me. So, it's there's not very many people out there that really understand this space. And then, those few people have to go out and educate everybody else in terms of these metals. Mining is tricky. It's not as easy as people think. It's not just, you send a truck out, fill it up with dirt with a shovel, and go throw some water on it, hope the metals come out. It's a much more complicated and complex business than I think people really give it credit for. So it's just an education thing. I definitely think this is just a temporary lull. We need all of these metals really to do everything that we enjoy doing in life these days, and where we're going. So I do think it's an unstoppable kind of momentum, on the broader picture of it.
It's interesting, how the world is changing. My son's a CFA, and he's actually like a coal guy. He's like sort of like the closet, Twitter expert on coal, unbeknownst to me. And he says like there's a whole community of these guys in various other commodities, and it's interesting. He said that they basically, these Twitter experts, they're all sort of personally, financially fairly well off. They like to do their own due diligence. So he said, when I was sort of saying, hey, you're sort of in with this community, you should be telling them about Power Nickel. He says the way they work, he said, and we're actually doing this week. They said they want to sort of model their own deposits. So he says you got to post up your Excels of all your drill holes, and they'll actually get in there and model it. And you give them your theory about how you think it's sort of shaping out the deposit. Maybe they buy it, maybe they don't, but they want to do their own work, and they've got the capacity and the core expertise to do that with software. And it's sort of interesting. I mean, there used to be gatekeepers in this space, right? That was the investment banks, and to some extent the companies themselves would have the information. But now it's like, now you've got, Crux investor educating people. You've got, him bringing on geologists to challenge your geologists. I mean, it's an evolving world. And I think it's sort of, the Twitter world, was sort of dominated by crypto and by tech. But now you're seeing a lot more. I was on an oil and gas call the other night. It was 270 people listening live to the debate on diesel pricing and the whole thing that's happening there over that. And I thought probably that didn't happen a year ago. So I mean, this is the momentum is building, I believe, and it's when this thing turns on. It's I think somebody was saying about, you're going to be, sucking some huge balls through a garden hose. It's just very tough. And so it's going to be a powerful move.
David, anything to add to that?
Yeah, I mean, I would reiterate what Brendan was commenting about, timelines and stuff like that. And, the new discoveries are taking longer and longer and longer to get into production. I think the big copper projects are now well over 20 years. So from discovery to production, and it's just getting worse. It's not getting better, in that there's greater regulatory burden on projects. The social aspect of mining, of course, is front and foremost in most CEOs' minds, and as it should be. I mean, it's a really important aspect, but timelines are getting extended, and that's going to put even greater pressure on the supply side. If it takes you longer to get permitting at every stage along the way, production just going to get pushed out further and further.
Right. Well, look, gentlemen, I'm going to wrap it up there because I think what we've done is introduce a little bit of new vocabulary. This is like for beginner's guide to session on, battery metal companies and in the junior space at the lower end, the higher leverage, higher risk, higher return profile. I think you've introduced a few thoughts there. Maybe if anyone's got any questions, we'll forward those on to the respective individuals, or all three of you for future discussion. But look, I appreciate your time. Appreciate what you're doing with your businesses, trying to do things the right way, which is always good, and that makes for much easier investing decisions for people like us. So, thank you very much for your time today, gentlemen.
Great. Thanks again. Cheers, guys.
Thanks for having us on, Matt.